2023 has not been a good year so far for legacy financial institutions. I'm seeing tons of negative press across the board for these banks. And in this video, I'm going to be running through what's been going on with Wells Fargo, JP Morgan, Goldman Sachs, Bank of America, Ally Financial, and to top it all off with SOFI. And let me tell you, for the majority of these names, it is not looking pretty. As you know, I cover SOFI on a regular basis, and as a result of that, I come across tons of articles and threads in the fintech space as a whole, especially as we enter this tougher economic period. By the way, before I go on, this is going to be a big video, so if you enjoy it, please subscribe now. 2023 so far, it seems as though many different streams are now converging into one from a financial perspective as well as from a news perspective. So let's start off with the news, and then we'll move on to the finances for all of these names respectively. Starting off with the news, just this month alone in January, there's been tons of bad coverage for the major financial institutions. Wells Fargo really started off this trend way back a month ago on December 20th, 2022, before even the new year started, when news came out that they agreed to pay a $3.7 billion settlement with the CFPB over consumer abuses tied to mortgages, auto loans, and overdraft fees. The bank was ordered to pay $1.7 billion in civil penalty, with more than $2 billion to redress consumers, the CFPB said in a statement. Wells Fargo said that this expense would be reflected in their fourth quarter earnings, which they just reported a couple of weeks ago. The article on CNBC also states that some of these issues continued until recently, from at least 2011 through 2022. The bank misapplied auto loan payments and made other mistakes, some of which led to improper auto repossessions according to a consent order. And from 2011 through 2018, the bank made errors in mortgage modification applications, the CFPB said in a statement. And it seems that across the board, at least in my personal opinion, Wells Fargo seems to be one of the sketchiest banks out there. In addition to this, just recent memory, they had a 2016 scandal involving millions of fake accounts as well. So it's not surprising, to me at least, they're getting hit with all of these settlement payments. Moving on down the list to something a little bit more recent. All of these are in chronological order, by the way. On January 16th, news came out affecting JP Morgan, who shut down Frank, which was a college financial aid website that they purchased back in 2021, as most of the users were reportedly false. JP Morgan is now suing Frank over this purchase, stating that the CEO of that company intentionally fabricated millions of fake student data. The CEO, Jamie Dimon, called the whole mess a big mistake for JP Morgan as a whole. And I commented on this on the SOFI Weekly podcast saying, how come a huge purchase like this, $175 million, there's no real due diligence that's done until after the purchase has been complete? So time will tell what happens with that lawsuit, how that shakes out. I'm sure there's a lot of details that we still don't know yet. Moving on, the third on our list is Bank of America, who on January 19th, more recently again, customers took to social media reporting that their funds had disappeared from their account after a delay in posting Zelle transactions. Now, in Bank of America's defense, I think the issue was mostly on Zelle's side and was resolved in a matter of days, but not before a ton of people grilled Bank of America on social media. A lot of negative coverage towards that name, lack of communication from the bank as to what was going on with users' funds, a lack of speed and transparency throughout the whole process until it was inevitably resolved. So definitely some bad press on Bank of America's side there just last week. And finally, moving on to the final bank on our list to cap off this month's negative news in legacy financial institutions, Goldman Sachs on January 20th. A Wall Street Journal article came out outlining a Federal Reserve investigation into the possible lack of oversight in their consumer business markets. Now, the full article is in the description below. It's actually a really interesting read. Goldman Sachs announced that it was pivoting and shutting down Marcus back in 2022 towards October, November of that year. And this was also when they announced the big 4,000 member layoff. And by and large, the failure around Marcus, which many people will remember, that is, the Goldman Sachs competitor to SOFI, their consumer banking division. This is a big reason that the CEO lately, David Solomon, has been getting into hot water. I discuss all of this in a recent video sharing all that we know so far about a potential Goldman Sachs acquisition of SOFI now that they shuttered Marcus. You can find that video attached in the description below and also up here. I'll also attach at the end of this video. So with that as the context, let's fast forward 1 month into January, and we know regulators have concerns that the bank didn't have proper monitoring and control systems into Marcus, highlighting potential management and governance problems. They're also investigating instances of consumer harm, compliance functions, in addition to an audit and legal investigation. The article goes on to highlight a history of Marcus along with their Apple partnership and their expansion of their consumer business. The Fed investigation is ongoing, and at the same time as a Consumer Financial Protection Bureau, CFPB, which you'll remember the same body that was finding Wells Fargo, is probing Goldman Sachs' credit card business as well. Goldman disclosed last summer that the CFPB is investigating their credit card account management practices, which also includes how the bank resolves bill errors, refunds cardholders, and advertises its card in general. Now, Goldman had some $16 billion in credit card loans outstanding at the end of 2021 when the year wrapped up, and the two agencies, so the Fed and the CFPB, are sharing information, people familiar with the matter said. And all this says to me is that it's not looking good for Goldman Sachs since they're getting hit with two different investigations with bodies that are collaborating with one another. And on the Marcus point, their CEO, David Solomon, recently highlighted to analysts on a call that we try to do too much too quickly. And what he means by that is since 2016, Marcus launched a savings account, personal loans, and credit cards. And let's contrast this now with SOFI, who since 2018 launched checking, savings, brokerage, crypto, credit card, relay, relaunched mortgages, and got their bank charter. So I don't know what he's saying about too much too quickly. Turns out it's not so easy to do what SOFI does. And we're now seeing that play out for Marcus as we saw it play out for Frank and a lot of these other legacy bank-backed initiatives. Okay, so that wraps up our entire month of negative news press for legacy financial institutions. Let's jump into some of the finances. Now, we first talked about some of the numbers in the previous SOFI Weekly podcast, and the reason this has come up recently is because many of the traditional financial institutions are just now in January reporting their earnings. Bank of America and JP Morgan reported good numbers a few weeks ago. JP Morgan destroyed earnings expectations, posting $3.50 in earnings versus the $3.07 expected by analysts. Bank of America also posted great revenue numbers thanks to higher interest rates. Wells Fargo missed on revenue, but they beat on their bottom line. Ally Financial, who reported on January 20th, just a few days ago on Friday, beat on both their top line and their bottom line. However, despite relatively positive results, the trend that all of these banks shared was a rising provision for credit losses. Ally posted $490 million provision for credit losses, up more than double year over year, about 230%. Wells Fargo posted $957 million, up $1.4 billion from the negative amount that they had a year ago. Bank of America posted $1.1 billion in provision for credit losses, and JP Morgan posted $2.3 billion in provision for credit losses. Ultimately, this was the reason why many of these names trended lower. Now, what does this mean? Well, just to recap for you, a provision for credit loss, or a PCL, is an estimation of potential losses that a company might experience due to credit risk. It's basically treated as an expense on the company's financial statements. This is a line on their income statement, and it shows that the companies are expecting a higher credit risk upcoming. And from that, there's a lot more defaults in credit portfolios in the coming months. Now, provision for credit losses, while it might be a little bit dense, is really important because the market uses this as one of the best forward-looking indicators into a bank's income statement. It basically gives us a perspective into what the bank expects is coming in the near term for default rates. And the warning signs that all of these banks are flashing is delinquency risks. What does that mean? Well, as interest rates rise, loans become more expensive to pay off, and as a result, more people default on their loans. This is an expense for the big banks, of course. This is also perpetrated by people losing their jobs and overall spending less as a result of that. Now, we're seeing more and more layoffs in droves. A lot of the tech companies are laying off people in the thousands, and this will all affect default rates because if I lose my job, I'll face difficulty in terms of paying off my loans, and ultimately, the bank will have to foot the bill for a lot of these defaults. So for all banks, including SOFI, all lenders in general, I should say, one of the key metrics going forward is looking at the delinquency rates. And just doing a quick search, you can see that delinquencies are on a rise. going into 2023, which of course is scary to see. But if we just zoom out to the 2008 financial crisis and we compare the two periods, we can see that the comparison is just not as scary as the first chart. However, the trend is that these are on the rise. So it is very much a real risk, and the banks are flashing the warning signs right now in terms of their preparation for what their forward expectations is for defaults upcoming. So in conclusion to this video, time will tell, but provisions for credit losses is a main thing that I want to look at for SOFI when they report earnings on January 30th. Of course, delinquency risk is one of the biggest risks owning any financial institution, any lender, any bank going into a year like 2023 where we're going to face tough macroeconomic conditions. My personal thought is that it's not going to be as bad as people think. Generally, banks, especially legacy banks, tend to be more conservative than they need to be, but it's still something to flag for SOFI going into this year. And from a product delivery and news perspective, just to do a mini victory lap for SOFI, because it seems as though January has not been a good news month for legacy banks. And just to compare some of the achievements, SOFI versus Marcus, SOFI's done way more in a shorter time span. Goldman Sachs is laying off people, whereas SOFI is hiring. SOFI's been more deliberate with member growth, actually reducing some of their spend to grow slower deliberately so that they can get higher quality members, whereas Frank, on the other hand, had fraudulent members. So we're seeing some things that are fundamentally different in terms of their operations and how SOFI is sustainably growing. Now, of course, this quarter is going to be a huge indicator, but if you zoom out, there is a ton to love about SOFI. If you want to learn more about the Goldman Sachs potential acquisition of SOFI, you can find that here and in the description below. I highly suggest you watch that next. For right now, this is the Fundamentals of Investing podcast. Thank you so much for listening.